Hey there guys, how's it going? My name is Chris Chillingworth. Welcome to episode number 54 of the FTSE Show, the show dedicated to the analysis of UK stocks essentially. We go through many stocks from the FTSE 100, the 250, the small cap, the fledgling and the AIM listed index. My primary role, I suppose, that I do on a day in, day out basis is I am the founder of the Sussex Investment Club, and essentially my role is to analyse companies for our members. I spend probably on a company that I've identified as something that I want to look deeper into. I will spend anything from probably 10 hours per company doing my analysis and then a few more hours writing up my reports. And we look at everything. We look at all the financials. We look at the why we would invest in this particular company. I've analysed over 1,000 companies and so far we've identified 54 that we would potentially want to own. But then on top of that, what we do is I run price analysis. So we look at those 54 companies, but we look at what's the right price to buy them at, because just having a wonderful business doesn't make it a great investment. It needs to be priced right. It needs to show a return on investment, and so we don't want to be overpaying for shares essentially. So in this particular episode we're going to take a look at a company called Boohoo, who are a British online fashion retailer, tend to be aimed at the kind of younger age groups. Their website says 16 to 30 year olds. And it specialises in producing its own brand of fashion clothing basically. The company IPO'd in 2014 and floated on the London stock market at 85 pence per share. Couple of notary kind of points, I suppose, in their short history so far. In 2016, they acquired a company called Pretty Little Thing Clothing, which was again aimed at the younger kind of young girls age group. However, in 2017, Channel 4, I think it was Dispatches, the investigative TV show, ran an investigation on Boohoo and found that they were only paying 50% minimum wage to their factory workers who were based in Leicester. And that got some pretty negative press and also scared a lot of investors off, severely knocking the share price down. In 2019, they acquired Karen Millen. You probably heard of Karen Millen. I've seen a number of their shops over the years, dotted about here and there in the UK, and Coast. So they acquired Karen Millen and Coast for 18 million. That was back in 2019. So probably just pre-lockdown, I'm guessing. And then 2020, they acquired Warehouse and Oasis for 5.25 million. So here's a company that's slowly pretty much picking up all of these failing retailers out there on the UK high street. Karen Millen, Coast, Warehouse and Oasis. However, they laid off all of the staff. So forget any semblance of rescue missions here in terms of coming in and rescuing these companies. They basically bought the intangible assets, the rights, the intellectual property, and they basically got rid of all of the premises and all of the staff and laid all the staff off from these 4 different businesses. And they only took on the online staff because Boohoo are an online retailer. They have no physical branches out there. They're not in the high street. This is an online retailer, so they didn't need any of that staff. In 2020, so we're looking at 3 years on from that Channel 4 investigation, the Sunday Times ran an investigation on the company finding that they were only paying their Leicester factory staff 50% minimum wage. So again, I think that was pretty much a repeat of what Channel 4's Dispatches investigation discovered. 3 years later, the Sunday Times have done an investigation and found out the same thing. And then the Guardian newspaper ran an investigation on Boohoo. This was also in 2020, and traced that their supply chain was traceable back to factories in Pakistan where the company were paying illegally low wages. Now, this has all been denied by Boohoo. This is all kind of speculative. There's been no like charges against them. So, we have to be honest here and say that this could be either way. It could be that the company have done nothing wrong. It could be that they weren't aware. It could be many different reasons for it. But this is what these papers and journalists are reporting. On the back of this in 2020, and it's all factual, it's all on public knowledge. You can look at the Wikipedia page for Boohoo. It's all on there as well. Boohoo responded by appointing Sir Brian Leveson to oversee kind of an ethical oversight of their business operations. So they've acknowledged perhaps that something is wrong and that it needs to be addressed. And in 2020, they appointed Brian Leveson to oversee the ethical side of the business. So, but I haven't been able to find anything about any changes that have actually happened or taken place. So I'm not really aware whether or not that's actually done anything or whether or not these problems still exist. But anyway, the shares lost 46% of value off the back of all this news. So it was pretty big. It was pretty important. Sometimes we see news articles coming out about companies that are negative, have a negative spin about that business, and the share price doesn't really do anything. But to lose 46% value means that it really did scare investors off from this particular stock at the time. In 2021, they acquired Debenhams for 55 million. If you're probably aware of what happened with Debenhams, they basically were running unsustainably. They lost a lot of money, and they couldn't continue as they were. And then Mike Ashley came in and tried to save them. Essentially, Boohoo came in and bought Debenhams, again buying the intellectual rights to Debenhams, buying the brand, buying the trademarks and all that kind of stuff, and laying off 12,000 staff. So they didn't really rescue Debenhams as such. They've just taken the name so that they can use Debenhams and sell it online. And I believe the plan is to create a Debenhams online website, essentially, as part of Boohoo. And then the same year, they acquired Burton Menswear, Wallace and Dorothy Perkins for 25 million. Again, laying off a further 2,500 staff from those particular branches. So they've come in, they have basically swooped up all of these high street clothing retailers. And I think the plan is to make it all online only. So the death of retail is certainly when it comes to clothing, is certainly arrived, I think. The company also announced in 2021 the expansion of their operations into 5 new key markets within Asia. And this includes Japan, Korea, Singapore, Hong Kong, and Taiwan. So the company have plans for some pretty big expansion into Asia. Doesn't necessarily mean it's going to work, but they certainly have plans to try and achieve that. And generally speaking, they're only going to do that if they feel there's a market out there for their stuff. So there's some encouraging positive news there as well. So we're going to dive into the vertical analysis then. So looking at this, as I did the analysis, we discovered that they just released 2022's data, which is great because it gives us a real up-to-date view on how Boohoo are actually doing. And as you can see from here, if you look at revenue, in terms of revenue growth, not a problem at all. These guys have grown wonderfully from having 67 million in revenue in 2013. That's not that long ago. 2013, 67 million in revenue to 1.98 billion in revenue in 2022, and you can see it really took off in about 2018. That's when the revenue really began to jump up year after year and the kind of skyrocket. So from 2018 to 2022, these guys have done very, very well in bringing in new business and increasing sales. Cost of sales has risen in line with that rise in revenue, but if we can look at the gross profit percentage, you can see that it's relatively stable in terms of when revenue grows, the cost of sales pretty much grows in line with that revenue growth. And so when you look at the gross profit percentage, we're sitting about 52 to 55% on average, roughly, per year, gross profit percentage. So of the revenue, after cost of sales, the cost of pretty much getting the clothing in, the gross profit before all the other deductions comes to about 52%. So that's healthy. That's great. That's a nice starting point for our analysis. However, this is where they become a little bit unstuck, because in terms of the expenses here, the company historically were spending about 88 to 90% expenses. That's bad. That's very high, because essentially what that means is there's going to be very little operating profit left over. Now, if you look at, for example, 2021, 87% expense rate. Okay, so the expenses came to 822 million out of the 945 million that the gross profit had. It leaves them with an operating profit, that's essentially gross profit minus the expenses, of 123 million. Now, 123 million sounds like a lot of money, right? Of course, but it's all relative. It's got to be relative to the business that you're dealing with and you're investigating. This is a company that year made 1.75 billion, but only made an operating profit of 123 million. And so, when you look at it relative to the actual size of the business, whilst 123 million is a lot of money, if you want to grow a company that's 1.75 billion in revenue, you're going to need more. You're going to need more profit than that to be able to grow it substantially. It's not going to be enough. Whilst, to you and me, we would love to have 123 million to grow with, right? But for a company like Boohoo, it's not enough. And it's not going to make a dent in what they actually need to do to expand, right? So it's a bad sign. It's the sign that the expenses of running the business are too high. If we look at 2022, however, things get really bad, because then you see the expense rate has jumped. So revenue's gone up. Cost of sales has gone up in line with that revenue, still at 52% gross profit, but that's not what happened to expenses. Expenses jumped significantly than what we would usually see. It's gone from 87% of the gross profit to 99.1% of the gross profit, leaving them with an operating profit of 9 million. So that's bad, and we want to have a look into why that might be, and I've got a slide a bit later on to explain why those expenses soared and jumped quite so high. Let's take a look at the earnings analysis. We've got our operating profit across the top line, we've got finance expenses, sale of assets, other income, taxes, literally nothing to really speak of in any of that. But what you will notice is that in 2022, the taxes came in at 11.8 million that they had to pay in taxes. Well, remember, we're starting from an operating profit here of 9.3 million. So we're in a loss territory, right? Reported profits, the company reported profits of minus 4 million. The true profits, because of this other income thing that came in, the 100 grand that came from somewhere, £100,000 cost. And basically it cost them 4.1 million in true profits. That is, if we look at the profit percentage down the bottom, historically this company are making between 5 and 6% profit margin every year once all costs have been paid, which is profitable. This is a profitable business, which is great, because so many out there aren't even profitable. I mean, I've looked at 1,000 FTSE stocks and the vast majority are unprofitable businesses, which I know sounds crazy, but it is true. So to have a company here that's making 5-6% profit a year, it's great. That's actually quite positive. However, the problem with only having a small profit margin is that all you need is 1 year of increased costs and the whole thing can come crashing down. You'll end up having a losing year. Losing years are terrible for investors because it just makes investors run a mile. If you report a losing year, then you lose investors and you'll struggle to get them back. And that is going to damage your share price significantly, because the laws of economics will tell you that when there is an abundance of supply, because nobody wants it, and there's no demand, then prices are going to fall, and that's exactly what happens. So let's take a look at the debt analysis. So historically, Boohoo, from 2013 to 2021, no problem with debt. Of course, they've been borrowing money. That's not a problem. We've got true profits along the top each year. Then we've got our short-term borrowings, our long-term borrowings. They really haven't been borrowing much money in their history so far since floating on the stock exchange. But the earnings to debt ratio has been absolutely fine. They've been borrowing well within their means. 2022 now looks terrible. Here's why. 2 reasons. One, they didn't make a profit in 2022. They actually made a loss. So we're looking at what is the earnings power of this company in 2022? Well, it's nothing because they don't make any profit in 2022. But also notice that their borrowings have actually jumped significantly to nearly 150 million. So not only has their borrowings suddenly kicked in and they're now borrowing 150 million, which based on 2021's data wouldn't have been a problem. Now in 2022, it's a bit of an issue because they're not making profit. So the question here for an investor would be, right, they're now carrying 150 million's worth of debt. Will they get back to being profitable? And the other issue you've got here is that they're now going to be paying interest on that debt. So that's going to take away from future profits. So even if they do recover back to 2020, 2021 sort of true profit level, they've now got this additional liability of having to pay off this debt each year, which is going to eat into the profits they can make. So it's a bad sign. It's movement in the wrong direction. I don't mind companies borrowing money. That's not an issue for me. I've always said, like, debt isn't always bad. If you can borrow at 5%, turn it into 8%, you've done, it's good debt. But when you're borrowing at the time when your profits suddenly plummet, that's not great timing, is it really? Let's take a look at equity analysis. So assets massively climbing since 2018. Again, all of these acquisitions that they've been making is going to help to that because they're going to acquire all these licenses and these rights and all that kind of stuff. So they're going to grow their asset base. And I would imagine a large percentage of that is going to be in intangible assets, rights and licenses to all these different brands that they've been buying. Liabilities has been growing with the assets, but not to a point where they're growing faster. As a result, the difference, the net worth, has also been growing. So it means that assets are growing faster than the liabilities are. However, 2022, we've seen the net worth kind of run a bit stagnant. It's not really gone anywhere. It's kind of stayed the same because assets grew, liabilities grew just as much as the assets did, essentially. And that'll be the debt that they've taken out that's lifted those liabilities significantly. And then retained earnings looks relatively healthy, I should say. We're looking at a company that's sitting on about 357 million in retained earnings. So that's nice and healthy. And it's an incredible climb from the 1.6 million that they had in 2013. So when it comes to price and analysis, well, Boohoo are currently trading at 83 pence as of right now. Obviously, that's going to fluctuate every second of the day, but about 80 pence is today's price. This is a company, remember, that floated at about that price. So they've come in, they've spent all these years slowly climbing and growing this business, and then it's all come crashing down back to where they started from. And a lot of that is the last couple of years, essentially. It's started to really go downhill. And that is investor sentiment. That is all sorts of reports that have come out from Boohoo over the last year warning about profits. I'm about to come to that in a moment. I've done my pricing analysis based on today's price and based on 2018's earnings. Because if I was to do them based on this year's earnings, it would all be zero. This is a company not making a profit. You do not invest in companies that don't make profit, right? Why would you? Maybe dividend investors might, but if you were going to buy a chip shop from a friend of yours or something like that, or some friend of yours invited you to come and be involved in a restaurant business that they were running, and you found out that restaurant doesn't make any profit, so the money you're going to invest, you're going to see no return on. It's not a great investment, and we should treat these stocks in the same way. Well, Boohoo aren't making a profit, and so right now, as a snapshot of right now, I wouldn't buy their shares for anything. It's too much of a risk. However, assuming Boohoo are going to recover and that they're going to have better years in the future, and that's a big if because we don't know if that's going to happen, but assuming they get back to, let's say, 2017's kind of level, Yeah, because it's probably not going to jump straight back to 2021's highs. It's going to take a few years to get back up there. Then I would spend no more than 60 pence on a share. So right now I would state that they are overpriced. Certainly right now I wouldn't buy them at all, based on the fact they're not making any profit. But if you were a gambler, if you were somebody who was looking at the long term and you thought Boohoo have a good long history, they're going to do well, I still probably wouldn't spend over 60p on a share right now. That's just my pricing analysis. And then, essentially you're gambling on this company and you're gambling on them getting back to 2021 results. And the question you've got to ask yourself as an investor is, do the facts suggest that they will get there? Will they get back to where they were in 2021? And you need to look at the facts to try and work that out. For me, not a company I would probably invest in. I've got a 2022 update because the new annual report has recently come out, and so there's a few things I want to talk to you about just to kind of wrap this up. They've reported, note this, they've reported they are expecting full year pre-tax profits to fall 94% to just 7.8 million. Notice that when we did these numbers, we saw that we'd made, or they had made a loss of 4.1 million. So instead of telling their client, telling their shareholders they've lost 4.1 million, they don't do that. They tend to pick the stats that make it look a bit nicer, a bit tidier. And so they've reported on their pre-tax profits because the taxes were 11.8 million, right? So they said, we've made a pre-tax profit of 7.8 million. To an investor that doesn't know what they're doing, they will look at that and just think, great, they've made a profit of 8 million. That's a lot of money. And they will be misled by that. And this is why it's so important to dig deep into the company's financials, because obviously once you take off the tax that they had to pay, they actually made a loss of 4 million. And that's a different picture altogether, right? So the reason why they think they've made a loss, obviously we know it's because of the expenses, but what expenses are we talking about here? Well, they report in their annual report that this was due to higher than expected return rates in the second half of the year. So again, this is essentially people returning products higher than expected return rates. So that's cost them money and it's increased expenses apparently. Subdued consumer demand during lockdowns. I don't see that myself. If that were the case, wouldn't revenue have fallen? Why would revenue be reaching record highs if there was subdued consumer demand? Maybe I'm missing something here, but to me that doesn't quite make sense. And then supply chain challenges, which many companies are struggling with right now, including extended delivery times and higher inbound freight costs. So it's obviously this the disruption with Brexit, with lockdowns, with the war in Ukraine, loads of stuff going on. It's causing a lot of problems with supply chains all across the world, and that's something that they've struggled with. A couple of things else to note here: 261.5 million capital expenditure investment. Building, so this is going to be a big part of why expenses were so high. So they've invested in building infrastructure for growth, including freehold properties and significant expansion and automation of their distribution network. So I don't know what half of that really means, but essentially what they've done is they've taken $250 million and they've invested that in infrastructure growth for the company. So this is a company that are clearly wanting to grow and wanting to expand. We talked about earlier on about their plans to expand into Asia. It says here 20 million active customers, so that's up 10% on the previous year and up 43% on 2020. So the active customer numbers are growing. That's a good sign. Announcement of plans for US distribution center in 2023, supporting the group's next phase of growth. So not only are they looking to expand into Asia, they're looking to expand into the US and build a distribution center in the US. That's great. That bodes well for bigger expansion for this business, for increased revenue. So that is something to obviously be mindful of as an investor. Relaunch of Debenhams adding a new dimension of a digital department store to the group's portfolio and extending the group's target addressable market. So essentially, they're relaunching Debenhams. This is probably going to be an online, by the sounds of it, digital department store. It's going to be an online store. I suspect it will be Debenhams.com, but just owned by Boohoo, who'll take all the profits or losses if it makes a loss. And it extends the group's target addressable market, because to date they've only been focused on 16 to 30-year-olds. Obviously, the Debenhams brand, that's a different demographic that they're reaching. And then the integration and relaunch of a newly acquired Dorothy Perkins, Wallace and Burton's menwear brands, complementary additions to the group's scalable multi-brand platform. So they're taking these brands and they're turning them into just digital online businesses. And that's it. That is the situation. We're going to look at the leaderboard. Before 2020's data came out, these guys were doing pretty well. They're scoring around 40 on the clean score mark. Unfortunately, this big drop-off in financial results in the concerns that have been raised has knocked their clean score down to minus 61. So it knocks them all the way down into third place out of the 4 companies we've looked at in season 2. Anybody who's looking at the expansion opportunities in Asia and the USA and thinking, and also the brands that are going to be released online, looking at that and thinking, will this grow? Will this company get back to where they were a couple of years ago? And that's a really difficult question to answer, but it comes down to that essentially, because if they will get back to 2021's data, if they will surpass 2021's profits that they were making, and if we quickly go back to have a quick look at what that was, they were making 92 million in 2021 true profits, so accurate profits there, 92 million. If they could get back to that level, then buying today at 80p, still slightly on the expensive side. I'd probably spend no more than 60 pence a share on this company, but if they were to surpass 2021, then you'd be willing to pay a bit more. And so therefore paying today at 83 pence a share or 80 pence a share, whatever they're currently sitting at right now, would probably make sense. But it's a big if, and it's a big risk, because if these things don't pan out, obviously they've got this new debt that's come in, and these problems that have caused the expenses to go up, will they disappear next year, or will they still be there? Because surely the supply chain issues will probably still be there. Will return rates be just as high next year? It's very difficult to know. But obviously with this expansion as well, maybe the expansion will help them recover. Very, very difficult minefield. And for me, because there's not enough certainty, because historically this company have only been making about 5% profit for the last 10 years per year, it's not a company for me. It's not a company that I would personally invest in. I'm looking for better stats. I know there are better companies out there that give me a much better opportunity to see share price growth. But at 80 pence a share, if you are a bit of a wheeler dealer, if you're a bit of a gambler, if you're looking for a bargain, it might pay off. So we're going to wrap it up here. Thank you so much for watching, guys, and I will hopefully see you in the next episode. Cheers.